Welcome to Real Estate Accredited, a free real estate educational platform where we go over the nuts and bolts of real estate investing. I'm your co-host, Jeff Rodriguez, with my co-host, Philip Schuligan. Chris is out of the office today, but today we're going to go over cap rates and what they mean. If you have any questions, feel free to drop them in the chats or unmute yourself. But without further ado, Philip, please go ahead and take it away.
All right, thank you, Jeff. Yeah, so as Jeff mentioned, today we're going to talk about cap rates and their significance. As usual, our focus is on in-place commercial multifamily, value add, and syndication, and we are the Boost Capital Group. So cap rates, in a prior session, we did speak a little bit about them, but we wanted to do a dedicated session today because it's probably the most critical part of assessing a deal and underwriting a deal in general. As an introduction, cap rates, which is the short for capitalization rates, as I just mentioned, is just such a major piece of real estate, commercial real estate, particularly investing. And I think, as a very simple definition, it's a measure of the return on investment based on the property income. And why we use cap rates in the world of commercial real estate, particularly, it's a tool that we use to evaluate the profitability of real estate investments. I'm not too sure about risks, but profitability for sure.
So just to caveat on that, so there's the associated risk, a higher cap rate. There's also allows you to see there's some associated risks, the higher the cap rate versus a lower. And as Philippe will go in further detail, lower cap rate in regards to multifamily or real estate, it's a safer area, more developed versus an area that is going through growth, which may have a higher cap rate. So that's why it's not straightforward. There's a couple of nuances, but
Yeah, that makes sense. That makes sense indeed. All right, so let's dive in a little more. So what's a cap rate? What's the definition, the formula? So cap rate, capitalization rate, is going to be the NOI, or net operating income, divided by the property value. We're showing on the top right here, as well as in the line on the screen. So it's very simply the ratio of net operating income divided by the value of the property. So it could be the purchase price, it could be also the current market value. So if you have, let's say, the cap rate for a particular market, let's take a 5%, for instance, 5% cap rate. If you have the NOI of the property, you can determine the value very easily.
So here's a quick example. So you have a property, a current market value of $1 million, right? And in the past year, the property brought in $100,000 of rental income, but then you have expenses, like $50,000 in expenses, and these just straight like round numbers. We ended up with a calculation of $50,000 minus net operating income, and we take the NOI of 50,000 divided by the market value of $1 million. So you have 50,000 divided by $1 million equals that 5% cap rate. So that's how that's determined, if that makes sense.
Yeah. So we will actually, next page, we're going to go a little more in detail how we can use that and use the equation and look at the value if we have cap rate and NOI. But just a quick note here on what is the net operating income. I think Jeff mentioned it, but just to make sure, go over that again. The net operating income is going to be the difference between the total income of a property minus all the operating expenses. So that would be, for instance, maintenance, management fees, utilities paid by the owner. Sorry. All things of that nature, but that excluding any debt service, meaning repayment of the loan, and it's also excluding any capital expenditures that would apply or be applied to the property. Yeah, as I mentioned, if you take the basic definition of the cap rate, which is net operating income divided by the value, it's a useful tool and it helps understand how you generate value in the context of a value add business plan, right? Because taking a look at this equation for the cap rate, if you switch the actual value and the cap rate, still the same relationship between the different terms, but you have value equals NOI divided by cap rate. So in other words, at that stage, when you do a value add business plan, so when you're able to increase the NOI by either increasing the income or decreasing the expenses, at using the same cap rate, automatically the value is going to increase, right? So if you increase the NOI, the value will increase as well. That's what we are saying here. And that's the pure definition of the value add business plan. Don't hesitate if you have any question. As usual. Next, we have what are the factors influencing cap rates? The typical, obviously, location. Jeff touched on that. I would say highly desirable locations with high growth locations, for instance, usually have very low cap rates. So that includes, for instance, like New York City, Los Angeles, like very big cities on the East and West Coast, but also any city with high growth, such as Dallas, Texas, Dallas Fort Worth. I know like right now, basically like a lot of cities in Texas, a lot of cities in Florida, for instance, they have strong or lower cap rates in general. And less desirable, conversely, less desirable areas, they will have higher cap rates. Meaning, again, if you think about the definition of what the cap rate is, if you have the same NOI, net operating income, for a property that is in a low cap rate area, it means that the value of the property will be higher. And conversely, same NOI, high cap rate area, the property value will be lower.
So just to piggyback off of that, usually when as an investor or a passive investor or an active investor, you're looking at comparing different properties in the same market. Obviously, you have an idea of what the cap rates can be. As an example, if you're looking at a apartment community that has a cap rate of 5%, and you compare it to other properties that have a cap rate of 4.7 to 5.3, you realize that you're right in the middle, so it's fairly comparable to the rest of the properties. However, if the cap rates are 300 basis points difference, that's a red flag. So you might want to dive in a little bit deeper and find out why such a delta between the cap rate of the property you're looking at to the average cap rate of that area. It could be a deal, but it could be also other underlying issues.
So next we have the property type, and I think particularly what's interesting to note here, for instance, and I think they give good examples: residential, commercial, industrial, but just for instance, I know often we're looking at, let's say, industrial or office space or self-storage, all these, it could be also mobile home parks. All these type of asset classes, they usually have higher cap rates. So again, go back to the definition, at similar NOI, you're going to pay less compared to multifamily. And here, so it means, I think it's well described here. So the perceived ability of that particular asset class to generate the returns is going to be stronger. In other words, if you invest in multifamily, where in general cap rates are a little bit lower than, say, self-storage, the prices are going to reflect that. And because there's always, for instance, demand on housing, Whereas you really need, if you have, it's like a part of a primary need compared to storing using self-storage space. Yeah, just to, I'm sure it's not the only explanation, but just to give an idea of why different type of asset classes particularly will have different cap rates. The other factor, and that's a chart we've shown many times, the supply and demand effect and the overall market conditions are going to affect cap rates, right? When the economy is doing well, interest rates are low, and usually there's a lot of demand, a lot of people want to invest. And as a result, cap rates are going to be lower, prices are going to be higher. Right now, we are more in a phase where I think the economy is not doing bad, but the interest rates are high. So then that led to higher cap rates and values went down because of that. So now interpreting cap rates, I think Jeff explained that a little bit, but earlier low cap rates, and it's tied also to what we discussed just before, but low cap rates, there's an indication of lower risk and usually at the same time, lower risks, lower returns, and it's going to be safe investments, higher cap rates, higher risk, higher returns. The cost of operating these properties is going to be higher, a lot more of unknown parameters. And that's basically here, in other words, what you're looking at is if you're looking at a class A property, meaning that it's a recent build, it's going to be more expensive, right? So there will be a lower cap rate again. You're going to pay more to generate the cash flow compared to an older property where there might be deferred maintenance and more capital to be invested to generate the returns and more risks. Automatically, if it's older, there are things that you're going to, it's higher cost of maintenance in general. So that's why between class A, lower cap rates, class B is going to be a little bit higher cap rates, and then class C, a little higher cap rates. I know at some point there was some, I believe it was CBRE was publishing the different flavors of cap rates. These days, it's a little harder to find this level of granularity of the different cap rates for the different class A, the different classes. But just something to understand that when you're looking at a more market average, I would say the average is probably more representative of the mid-range, meaning like the class B type of properties, not too recent, not too old, for lack of better description. But you can expect that a better quality property will have a lower cap rate than that, and something that's a little bit older and in worse shape, there will be a higher cap rate. And I think it's you can use the cap rate to compare properties and see how they are doing and what compared to the prices, compared to the NOI. Sometimes it's not obvious to get all the necessary information, especially for instance, in Texas, where it's a non-disclosure state. The buyer doesn't have to disclose the purchase price. Just a little something to be aware there. But I know, for instance, we often use CoStar as a reference. They're doing a good job surveying a lot of owners and sellers and buyers, so they have sufficient amount of data to be able to develop statistics on cap rates, etc. So how to use cap rates, practical applications, investment analysis. And that, I would say, it's a more, let's say, from a broader perspective, if you're comparing different asset classes or even different investments in general, that's a way to look at comparing them and see, okay, I'm going to pay X to get Y as an income. And that's a ratio because if you think about it, if you're buying a property at that price and there's no debt on it, the net operating income minus expenses, that's going to be everything that you're going to collect, right? That's going to be your cash flow. So in other words, if you're buying a property at a 5% cap rate, and you're buying that property cash, you're going to generate 5% cash on that particular property if you buy with no debt. So now you can think about the cap rate as being your return on investment as well. And then that's how you can compare the different investments. However, I think what's interesting there is that in real estate, it's relatively easy to obtain debt on an investment. And now you're going to multiply the power of your capital invested. And that's where you have to look a little bit closer at the analysis on the returns and so on, because the cap rate is less relevant at that point.
And yeah, like Philip said, just keep in mind that there's data points that are much more significant to investors, such as the hold period, distribution, splits, things of that nature, your return on your investment. But this is a tool to help you determine and analyze a deal as you're trying to figure out comparing apples to apples, for lack of a better term.
So the next use of cap rates is it as a valuation tool. And here, what we mean by that is like when an appraiser and is going to look at a particular property, they're going to use different means of valuation. One of them is to look at the market cap rate. So all the similar assets that sold in a similar market and make an average of the net operating income divided by the sale price or purchase price, depending on where you stand. And that will be the market cap rate. And they will use that market cap rate and look at the current NOI to provide an appraised value of the property. Again, it's one of the valuations. The other forms of valuations are going to be a per unit type of pricing, also based on the market. And the third valuation methodology is going to be the construction cost, with a factor depending on the age and so on. But those are the three methods, actually. Now, actually, also a little bit of additional for people who are not confused enough, unfortunately. There are many flavors of cap rates. And that's why sometimes it's a little bit confusing because you have different people talking about the different perspective on a cap rate. And I listed a few that I've heard of. Actually, while I was preparing these slides, doing some research, I came across different definitions for the same nomenclature. And I've heard that before. It's not, somebody was talking about maybe not the in-place cap rate. That's pretty agreed upon definition, but particularly the going in cap rate, I've seen three versions of that. It's very I wouldn't be necessarily too worried about that. And I think in my opinion, there's only one value that matters, and it's going to be what is your exit cap rate, which I didn't even add to the list. I can add it quickly.
Yeah, you'll hear it as your revision cap rate.
Reversion?
Right. Your
I think,
revision cap rate, which would be pretty much your exit cap rate.
yeah. So exit cap rate is just like it's going to be the market cap rate at sale. And so it's exit, it's also reversion. So this is a key. This is a key. That's the most important. And usually the way to start with the bottom of the list, at the bottom of the list here, usually we take the market cap rate and apply some expansion to it to have a little bit of a buffer to anticipate, let's say, like I mentioned earlier, when the economy is going bad or interest rates are higher, usually the cap rates are increasing a little bit. So that's why for exit cap rate, you're going to take a look at the current market cap rate and increase of 0.1 or 0.15%, 15 basis points per year, for instance, or more. But let's go over the other, all the various cap rates I have here. So in place cap rate, you're going to look at the trailing 12 months of net operating income that you divide by the price. The going in cap rate, usually, but not always, but usually is the first 12 months of your pro forma NOI divided by price. And that's the one I've seen, like the 3 or 4 definitions. I've seen for the same thing, I've seen the stabilized cap rate used. So which is the stabilized pro forma, meaning that usually it's going to be your 2 or 3 of your business plan because it's going to take 12 months plus to renovate, let's say, all your units. And the other one that's interesting, and I've seen also for going in cap rate, this definition used that is, in my opinion, more the all-in cap rate. So you're looking at stabilized pro forma divided by not only the purchase price, but also the fees and the capex budget. So basically, all in from a dollar standpoint that's going to be invested by the deal, and you're comparing that to what's your target in terms of NOI. So finally, on this list, I have the market cap rate that I mentioned earlier. So you're going to look at various assets that have been sold, comparable assets, similar in size, vintage, and market. And you just make an average of the net operating income divided by value. But as I mentioned, it's not an easy task necessarily, and that's where I know it's interesting to rely on larger data provider and companies who provide this type of service to gather the data. It's very interesting. I think the most critical exit cap rate, important to know because that's your baseline market cap rate. After the other ones, they are interesting too. I think they have a place to be used. But when you can evaluate the all these cap rates for deals, I think it's extra steps, not necessarily important, but some people do have seen that in some underwriting. It adds another statistic. I'm not personally a big fan of that. There are many other ratios that are mandatory to have, such a debt coverage ratio or a nuance of that, which is the debt yield. I think we'll talk about this in another session in the future.
One thing to touch on is real quick, the exit cap rate. Philip had mentioned the basis points. So depending on the class type, class A, B, or C, there could be a certain basis points associated with that. For example, class B, they need some upgrades, but it's an older property. You might want to apply like a 10 basis points, so 0.10% for 5 years, which gives you like that 50 basis points. So if you start with that 5% cap at acquisition and you apply like a 10 basis points per year for that 5 year hold, your revision cap rate would be at 5.5%. So just as a real quick example of that, in case there was some confusion, but that's pretty much it for that.
All right, last slide. Just, yeah, some limitations, considerations in general. To simplified snapshot of the performance. Of course, I think it's not, and I wouldn't say like we said, the market has an influence, the class of the property, how recent the property is going to be. It has an influence on cap rates, and as mentioned previously several times, it is relatively complex just to gather data on this. So I think at the end of the day, there's a lot of doubt, but uncertainty around the cap rate. So at the same time, it's such a important factor. You never know because you can expect the market to be at a certain level and something happens when you have a black swan event. COVID started and nobody was buying properties at the time because we just nobody knew what was going on. So effectively, it's interesting because if you look at charts, like the change in cap rates is very low, but there was no transaction really at that time frame. So even though, so what was the market cap rate at the time? Nobody's buying anything. We could argue it doesn't even apply, or it could be like in infinity or zero, depending on how you look at it, but it's not a real thing. So I think at the end of the day, what's important is before you go into an investment, ask yourself who is going to buy the property at the end. Because if there's nobody to buy, cap rate or not, that's not going to make any difference. Just some food for thoughts for anybody who is considering going in very small markets, for instance. And as to continue on the same train of thoughts not the only indicator that you should use to gauge an investment opportunity. And yeah, there are many factors to consider. I know that we had a session, I believe, 2 or 3 weeks ago about assessing investment options. We went over that. Today was the session about cap rates. We wanted to take a deep dive and look at cap rates under different perspectives. And hopefully this was helpful. As usual, you can reach us. Subscribe to our YouTube channel, youtube.com/@boostmycapital. And you can see on the screen, you have our emails. You can use the QR codes to reach our individual pages. We'll open the floor for a few minutes regarding anyone with questions on cap rates.
I'll just end with this. The takeaway is the cap rate ultimately at the end is it's a measurement made at that specific time based on the performance of that property. So just keep that in mind. It's not the end all be all, but it's that specific time where the acquisition is taking place or that sale is going to take place. You look at that cap rate. So at least just something to take away with you. If we don't have any questions, you know how to reach us.
Good. Thank you.
Absolutely. Thank you.
You're welcome.
Thank you for stopping by.
Thank you.
We're always available. Shoot us an email. Schedule call if you want to go over anything specific. We're always welcoming topics of discussion that we can add value and provide something that people are actually interested in. If cap rates are too dry, let's find something else that may be of interest. We're always for suggestions.
Thank you, guys. Great job, as usual. Thank you.
Thank you.
you.
All right, everybody.